Morning, Chris. I think this is going to be the
Good.
fastest episode we've ever had. We're going to ask one question, yes or no answer, and we're done.
That's pretty much it. I somehow think that this might be a good little spicy episode, Anthony. I think that well, I don't know. I'm interested to have the conversation. But in Anthony, did you know that in 19 oh, excuse me, is the money you're chasing actually slowing down your business, Anthony? You ever
I'm
had deja
taking the
vu,
readings away
Anthony?
from you. You're no longer do the reading.
Have you ever had deja vu? It's just weird. It feels like I've done a very similar reading to this past. In 1995, King Fu founded GeoMagic with just $500,000 in seed funding when 3D technology was barely on the radar. Rather than pursuing multiple large funding rounds, she strategically raised minimal capital, maintaining control while developing groundbreaking 3D imaging software. When she eventually sold the 3D systems in 2013 for $55 million, Fu had retained significant equity and complete vision control, proving that selective strategic capital raises often outperform the raise as much as you can mentality. Today, Anthony, on How to Founder, we're talking about the strategic decision to raise capital. I am Chris Franks. With me is the surly, grumpy.
Surely. I like that. I'll take it.
Surly is a good one. Surly is a good one. Mr. Anthony Franco. Hi, Anthony. Glad to see you. It is a wonderful Thursday here in Denver, Colorado. We are joined today by the person who has all his IT problems completely under control at all given times, Mr. Salvatore Tirabassi. Did I say it right, Salvatore?
You got it. You got it right. Yeah.
Cool. I can also see I just feel like it, you should be from The Godfather. So, all right. And you.
I don't like that phrasing at all, Chris. That's not politically correct to say.
That is probably not politically correct either. Yeah, but
I've been there before, so it's been there before. So not.
I mean, I'm going to start calling you Tony Franco. Have you ever gone by Tony, Anthony? Ever?
Yeah, when I'm in trouble with my wife, she calls me Tony. You know why most Italians are named Tony?
What's that?
Because that's what it says on the boat coming over to New York.
To New York. All right, there's at least one of the good and slightly off-color dad jokes. All right, Salvatore, with over 2 decades in finance, Salvatore Tirabassi brings hard-earned wisdom from both sides of the table. After 15 years in venture capital, times as CFO at high-growth environments, Sal cuts through financial BS to help founders make capital decisions that won't keep them up at night. Sal, welcome. This is a big topic. Why should I, as a founder, care? Don't I just go raise as much money? If I can raise money, I just raise it, right? Because then I get to pay myself.
Yeah, I mean,
quit my day job.
You definitely should. There's a phrase that often gets floated around in venture capital, especially, but also in kind of lower middle market private equity deals. Is if the capital is available, you might as well take it and take more if you can. And obviously you balance that with the price and the cost of that. If it's equity, how much more is it going to dilute you? If there's weird terms and preferences and that kind of stuff. And then on the debt side, how long is it going to take you to pay it back? How aggressive are the payment terms? But you factor all that in. So, my view is, listen, if someone's if you're doing a good job and someone's putting a deal in front of you to raise some capital and you feel like they could be a good partner, you have to take it very seriously. It should go number one on the list pretty quickly.
So what you just described, really, I've seen it now probably 3 different cycles where good, healthy startups got real scared about the capital markets and just went and started and raised a ton of capital. I think there's only one company that I know that did that still exists. The moment you go out and raise a lot more capital than probably you need to hit your next benchmark, it puts additional pressures and stress on the business, right? I think this is one of those big, it's a great conversation to start off with, which is, let's assume for a moment that your business does need capital. We'll have that conversation about whether your business does need capital. But let's assume that it does. Let's start with a conversation of how much money you should raise and why. And Sal, to your point, there are moments where the markets do turn and it's harder to raise capital, like over the last 18 to 24 months, because our VC friends have been hiding. Where do VCs hide, Anthony? I mean, I'm assuming probably at racquetball clubs. I don't know. That's just my guess. Squash, maybe? Do they play squash? Sal used to be
Some of them, I'm sure. Some of them, I'm sure, play squash. Yeah,
squash.
But
yeah, okay.
I know some that play
so
basketball and do other stuff like that. So, but
it's fair.
I was gonna say Epstein's Island, and I thought better of it. So I'm glad I didn't say that.
Straight to the quick. I'm glad you didn't say that either, Anthony. Glad you kept that thought and kernel into your head. This is the Austin Powers. How do I tell them that I have no inner dialogue? Sal, so how much money should we raise? Like, let's just start there. Like, what is the right way for us to model out? I hear people all the time that go, hey, look, I've got this business. I think it's going to be great. I'm going to go out and raise $1 million seed. Why $1 million? Because it's a seed round, and that's what I'm supposed to raise.
Yeah, I think if you start from like the real early stages and you're looking at pre-seed, seed, obviously the dollar amounts get smaller. And if you can't self-fund it, you're going to need to raise that capital. So there, I think the need is pretty obvious. How much you should raise, actually, for a period of time, I think seed and pre-seed rounds were getting bigger. I don't know where they are today, but that is also a thing to factor in, is like, what is the appetite of the market for the size deal that you're looking to raise? Because investors come in a little bit with their own perspectives on what is pre-seed and a seed, and maybe even a Series A deal. What does it need? And they want to make sure that you have enough capital to really achieve the milestones and objectives. And I think in those earlier stages, it's really, trying to get to that product market fit and have, pre-seed evidence of that. And then in the seed stage, really that, hey, I actually have built something that someone is willing to take on with some level of financial obligation to me. And that is a lot of tea leaves reading, in my opinion, unless you are, and I don't see this as often as I would think. If the founder is a true subject matter expert, they typically can beeline it to product market fit. They have a better chance of doing that because they're not making it up because they think it's a problem. They usually, when you see those folks, they know it's a problem. Like I was just chatting with somebody that was in a SaaS business in the auto compliance space and went from, 0 to like, I don't know, 50 million of ARR in 3 years. And it was founded by somebody who was dealing with those issues every day and said, there's a better way.
The auto compliance space. Yeah. If Anthony and I tried to start that company, we would
better opportunity to fix it. So if you're coming in with a general understanding of the product market fit that you're trying to get to, but you're not a subject matter expert, I would say plan on it taking longer, and raise more. Or try to raise more. Be critical of yourself, because catching lightning in a bottle when you're not a subject matter expert is hard.
So Anthony, I'm going to let you be the contrarian, even though both of you and I could put this hat on at any given time. You raise capital, you've bootstrapped. Why should you not raise capital? What are the elements and scenarios where you should just ignore the concept of raising capital?
I think the list of why you should raise capital is a lot shorter than the list of why you should not. Um, you should raise capital because if you don't, the opportunity um, doesn't achieve its full potential. I think like if there's some, and I think it's a very, very small minority, like less than 1% of startups should go out and raise capital. Um, most founders are most founder run businesses are bootstrapped. The and we've been taught over the last 10 years that here's what you do: you go and you apply to an accelerator, or you create a pitch deck, you go around and try to pitch venture capital your idea, see if you can then you go, and if you can't get seed round or angel round, you do the triple F round, friends, families, and fools, and try to get them to invest
really
in your
awkward
company.
Thanksgiving dinners.
Yeah.
Like, thanks, Mom. Thanks for giving me some money.
And that's the way to raise capital. And the truth is, Chris, you and I have both seen it. We've seen really great bootstrap companies get completely ruined by capital.
I think that's really the first lens, Sal, to look through is, so, we started with the assumption of, yes, you should raise capital, but let's back up that one step.
Yeah.
I think that Anthony is right, and I think it's a great conversation for us to have, is what type of companies should raise capital. Anthony, you said the first one, which is speed matters. And there are not a ton of companies that I know where it's the old Peter Thiel 0 to 1. Like, if I don't beat everybody else to market and I don't dominate this market, and if I don't dominate this market in the next 18 to 24 months, I don't have a business. There's not a ton of those opportunities unless you're Peter Thiel, in which case, Sal, Peter Thiel's our sworn enemy on the show.
Is he really? Interesting.
We just decided to have a straw man and Peter Thiel say, because he hasn't returned any of my calls. Anytime I've tried to raise from him, he isn't. Call me Peter. But so what? Like, that's one criteria. What are the other criteria in your mind where a founder-led company should go out and seek capital?
Should or shouldn't? Sorry.
Should. Like,
should.
What are the scenarios? What are the filters where I should be doing this?
I think that I'll answer that a little bit a different way. If you are on an express lane to product market fit, like you can imagine a pre-seed deal that comes out of the gate with like a demo product and gets adoption and starts pricing it out. In that instance, I would say you could take your foot off the gas a bit, because if you can self-finance your customer acquisition costs, you can really bootstrap to some version of flowing enough revenues to cover your expenses. I think if you're not in that situation, and that I think could take two forms. You're either far away from product market fit, you don't really know what you're going to build, or like you know what you're going to build, but you don't know what it's really going to look like at the end, and how are people going to be falling over to buy this stuff, or you've gotten part of the way there and it's just a long sales cycle anyway. Then you really need to think about how are you going to fund it, unless you can self-fund it, but that only really can get you so far. So I think it's really about the length of the sales cycle that you're anticipating, and being able to insulate yourself from the figuring out that you need to do sort of along the way. And one of the traps too that are I don't want to say traps, but one of the common elements that I would say would lead you to really want to raise the capital and raise more capital is that many founders that I meet are product people and not revenue people.
Yeah, and they need to go hire that person, and that person.
Yeah, and they need to hire that person, or they need to develop their own knowledge of how to do it. And that just means like if you're going to be heads down in the product, you just need more money, because the product is ultimately going to get you the sale, but selling and messaging and doing all that stuff is going to create more need for capital if you're learning how to do it on the job. A lot of
founders that have listened to all 77 of our episodes, or 87 of our episodes. Anthony and I haven't even listened to all 87 of our episodes. I don't even remember what we talked about last week. Anyway, they will know that we suggest that founders need to sell regardless, no matter what. So, but you bring up the great point. So speed is one. Sales cycle is a really important one, Sal, because there is a point there. If you're selling a complex solution into a very big business, you've got to figure out a way to stay alive long enough to be able to make that happen. And I think that that's a fair point. That's a good second reason. I think I'll add a third, which is there are capital intensive businesses. I've been spending time looking at medical devices lately, and it turns out you need to pay people to actually prototype those. You need to pay for the approval process. And there are businesses that are gonna need capital. Yep. So there's probably a couple more, but let's stop there just for the sake of time. And let's ask the next obvious question. How much? Anthony, I'm going to start with you and then ask Sal. How much capital do you need to raise?
So how much is, it depends on the stage, right? So if it's seed versus Series B, and so on, how much, if you decide to raise capital, and I kind of go back to default to Sal, as much as you can possibly get.
I fully disagree.
I know you do, and because here's the contrary position to what I just said is, you want to raise as little as you possibly can get. So that's one argument, and the little as possible you get to get you to what stage. And I think that founders highly underestimate how long capital will take, how far capital will take them.
I don't know why you're throwing stuff, Anthony. I could just, I think they underestimate.
So I think when I say however much you can get, your investors are going to take an objective perspective on your business and say, these guys need at least this to get to this stage. They're going to have a more objective understanding of where to take your business than you are. So I would kind of like, if they're offering you 2 million, take the 2 million. If they're offering you 20, take the 20, because it's going to ultimately mitigate your risk. Now, how you deploy that capital is a whole nother story.
Yeah, that's a different episode called capital efficiency, which we haven't really talked about that much.
Anyway, that's my perspective. Sal, I'd love to hear your take on it.
Yeah, Sal, what do you think?
I think regardless of stage, it's you should have a budget for how much and how long things are going to take.
And then add 100%. Is that?
And I was going to say, then just double it. I mean, but what you can also do is, if you've got good resources and contacts, you need to have people sort of scrutinize the assumptions that you're making on the timeline. Now, if you're a Series B deal, you're already selling. You've got more of the mechanics of a P&L that's working, and you know what your receivables look like and how long it's going to take for you to get paid. If you're in a SaaS business, you're also going to be looking at how much deferred revenue is going to be able to fund your next set of sales, which is, one of the super attractive things about that model. But you're obviously going to have a budget there. Earlier, you're really looking more at an expense-driven budget. And you should have other people scrutinize how long they think it's going to take. And the more expertise they have, the better off you're going to be. And then build a pretty solid cushion in there. And then I would say you also don't want to hit the market with a ridiculous number. If you end up in the ridiculous zone, or you feel like it's a ridiculous number, like either too low or too high.
Yeah.
You want to revisit that and think about it, because you can lose a lot of credibility talking to investors if you're talking about something that once they start to peel back the onion a bit, they're like, this is just weird. I don't see that they need 10. I think they need 5, or why are they only asking for 2? They really need 5, and you can lose credibility in terms of your own leadership and management capability because you're just presenting them with something that they don't agree with. So you got to like test the concept too, and know, in that pre-seed to seed, like what kinds of investors are you talking to, and what size numbers do they generally think about. And then another way to look at it is project out. Let's say if you're going to raise 5, project out what you think, how much you think that's going to be worth if you're successful going forward. So you have a good concept of how much is this investor going to make in the next round. I actually have a calculator on my website that does forward dilution analysis for founders, where you can put in, all the way through Series D funding and valuations, and it shows you like the dilution that happens over time. But that's like a quick analysis that you could just do to level set. Is it enough money for me? Does it make sense to the investor? Am I going to appear credible? And then when they put that money in and we do well, how much is that going to be worth in the next round? Then of course there's also the structuring of the deal, where in the earlier stages, you can use convertible debt or a safe and not really define the price up front. That's a structuring
you
mechanism.
kind of do, and really quick, you kind of do define the price in a convertible note or in a safe, because there's a cap.
The cap.
That's true. There is
the
a
price,
cap,
right?
Yeah.
Essentially, I've always looked at convertible notes and safe as like better for the investor than the founder, because there's you're really defining a cap, and they get the benefit of the downside.
They do.
It's just faster and easier. I think one of the things
it is faster and easier. That is true.
I want to just kind of rip up one of the points that you said, Sal. Founders and entrepreneurs come to us all the time. I can't remember the last time somebody came to me and said, I really need you to punch up my expense side of a pro forma, which is probably still one of the that is one of the most important elements. If you're planning on raising capital, is understanding what you're going to be spending out of 18 to 24 months, whatever you need this capital for your runway.
Right.
It's so critically important, Sal. It's just one of those things. And it's like, I think I can hire this VP of sales for $36,000 a year and give him 2 points of equity. It's like, well, I don't know, man. Have you checked the market? Have you truth told? Have you gone out and looked at Indeed or Glassdoor and see what these people are going for? Just for the sake of time, I want to move to the next conversation. So the question then is, we know that there's limited amounts of companies that should be raising capital. We're going to push the bootstrap. We've talked about it a lot, Anthony, to another day. For this sake, We'll say what type of companies and then how much. And to your point, Sal, we as entrepreneurs are wildly optimistic people. We think we're going to get from point A to point B without any hiccups or challenges or market issues or any of that sort of stuff. So we tend to shorten that kind of expense side. And a good, somebody who really knows this business and knows startups can help you truth tell a little bit to get to a better, more accurate number. But we've missed that one point, which is when we say we get to the next milestone. Milestone is one of the most overused and misunderstood terms in our business. When I'm raising a seed round to get to a milestone, what is that? And what's the next milestone? So just briefly in your mindset, so take me through what is a pre-seed milestone, what is a seed milestone, what is an A milestone. We don't need to get to B because that means it's just your growth rate really is at that point.
Yeah, I think a good pre-seed milestone is having an MVP, maybe even slightly better than an MVP, in the hands of beta users who are like legit potential buyers of the product. And really, and this is where subject matter expertise can come into play, where you have a good network of potential buyers or if you don't know them and you cold call them, you're showing up with a tremendous amount of credibility because you know exactly the problem that they have. And then you sort of work through whatever their IT department says about them being able to demo and participate in something like this. But you get that over the hump, and now you've got an audience that really wants to play around with the MVP, and you should have them on like a program where you really are getting like formalized feedback from them. And what's the benefit to them? The benefit to them is they get the product early. You're going to give them preferential pricing, and you want to find people that are going to be really interested in the outcome. So you do have to cast sort of a bit of a wide net to make sure you have enough of the people. You don't need like 30 of them, but you want to have like 3 to 5 at least. But that would be like a pre-seed milestone that I think is pretty important. And then when you accomplish like satisfactory results from the MVP, and you really are then defining a roadmap, and you also are starting to get input about how much am I going to charge for this from real users? How much would you be willing to pay? Then in the seed round, I think you're really going for, I've got product market fit and I want to sell this not just to my trial users, but I want to get somebody to pay, near full price for it, who wasn't part of my initial group. And that would be like the milestone there. And I think that, you think about some of these founders who are very product focused, you also need to be very client focused and be a good networker, not just for your investment, taking an investment, but you need to be a good networker with the audience that's going to be potentially participating in that MVP version and then the full version.
Can I get an amen? Thank you, Sal. That's my mantra. It's like, stop building product. Go talk to people, man. Go talk to customers.
You got to talk to a lot of people and spend time with them, and give them, what I always find is valuable, and especially if you're coming from a subject matter expertise standpoint, is you may have seen a lot of things that they're struggling with that you've solved. And the way you build rapport with these people is you offer them stuff that's unrelated to your MVP that you happen to know that will just make their life easier. Hey, before I left to start this, to build this MVP, one of the coolest things I did was I used ChatGPT to create this little applet that I used that did these 5 things for me, and made my job a lot easier. You may want to, if you're curious about that, we should set up another call to talk about that. You got to give them something to like build rapport and also a lot of credibility. And that's all, it's all what networking is about, right? It's about like, give something up and worry about the payback later.
For this show, Sal, we're going to show you the fact that Anthony and I aren't even real. We're our digital twins. We're just going to show you how we did that.
Everybody knows, Chris, if we were to choose a digital twin, we would have made him a lot better looking.
A lot better looking and smarter. And I would have really good.
You would have great
I'd
hair.
have Sal's hair. Like it would be like that would be pretty terrific. Anthony, just briefly react to that. Yeah, from a founder perspective, what are those benchmarks? And just in as plain of English as you can, where do I need to get to my next round of capital?
Yeah, so once you just, I struggle with this, Chris. I'll be really candid, Chris and Sal. Because once you get into the world of venture capital and raising capital, it's so counterintuitive, especially for earlier stage companies. A lot of it doesn't make sense. And I've seen really terrible ideas gain traction and really great companies not. And I couldn't necessarily objectively tell you why. I'll give you an example. I've seen companies that raised a ton of capital be pre-revenue. Then they start getting revenue. They start getting traction. And all of a sudden, that revenue means that they have numbers to show, and they go out and raise another round. And now it's like,
now they have actual. Yeah,
now they have actual numbers, and the valuation drops because they're measuring the company on their revenue and not on the things that they were being measured on pre-revenue. And it just is like, it's so counterintuitive. It's like, wait, we're crushing what we said we're going to crush, but now we're getting a down round because you now have something legit to measure me against.
And before it was your imagination, really. And when you said, conventional wisdom is,
and there's companies that in the AI space, there's companies that are doing 15, 20, 30 million dollars in revenue, struggling to get around, and there's companies that are pre-revenue getting billion-dollar valuations. Like this doesn't make sense. And I think you need to know that when you go into it. Like, just it's counterintuitive. Whatever you think is logical, you kind of have to set that aside and then get into the heads of the people dishing out money and try to figure out what their motivation is for putting money in, and then kind of kowtow to their motivation as well.
Sal, we're both big Seinfeld fans, so bear with me. Anthony, what was the episode where it's Bizarro World?
Yes,
Bizarro World.
Bizarro World.
It's Bizarro
Yeah,
World
exactly
business,
right.
where it's like, sometimes
it doesn't make sense. A lot of times it just doesn't make sense.
It's a great point, and I still think, in my mind as a founder, seed, I want to have something, pre-seed to seed. I just want to have something that finds it's all about product market fit. It's provable product market fit. And A round and beyond is proving not only that I have product market fit, that I have a business. Mm-hmm. So it's about the business. That's at least in my mind. But there's one more line of questioning I want to talk about, which is, and Anthony, you hit on this earlier. In Bizarro World, we as founders have been trained not oftentimes to build great businesses, but to build great pitch decks or great VC backstories. And it will get you capital from time to time, but those businesses, Sal, are not the ones that make it. The ones that build great businesses are the ones that make it. And I think that that's really been the pivot point that I've seen over the last 3 to 5 years, which is people are like, okay, it's been great that we've had this goal to venture capital over the past decade, but now we need to get back to be disciplined operators and run great businesses. The question now is when. When do I go raise capital? And I get it, it's whatever you can, et cetera. But I'm a huge advocate, Sal, of going as far as you can down the road to prove the point, to de-risk the investment, because it puts you, the founder, in the driver's seat more in those VC conversations. Is that a fair piece of advice that I give founders, Sal?
As long as you are effective in managing your runway, because that I think taken in out of context, what you just said, would indicate that you're really going to stretch the dollars, which you're going to do as far as they can go. But capital raising takes a lot of time, and if you're running in parallel paths along the way and you're maintaining your presence in the investment community all along, you should feel like you have luxury of like getting to market and being effective in a shorter period of time, because you're networking and you're developing relationships with prospective investors while you're doing the product market fit. And that gives you the luxury of doing exactly what you said. So I think if you can maintain your investor relations strategy and your investment community presence as you're going along, it's going to give you more flexibility to stretch the dollars and, try to capitalize on the moment where you've got the most to show. If you neglect doing that and you wait for the moment you have a lot to show, unless you got something that is completely going to light the world on fire, you should know that it's going to take a while to get that whole message out there. And you need to you need to plan for that, and you don't want to be in a situation where you're running on fumes while you're doing that, because that's just.
It's a fair point. So when I'm saying move further in your business before you raise capital, it does not mean don't go talk to investors. It means you should probably start talking to investors now, but try to wait as long as you can to do that.
Wait as long as you can, yeah.
So a lot of so a lot of I put it down to, like, when you're raising capital, investors are looking, they're pattern recognizers, right? They're looking for patterns that they've seen in the past that they're trying to map to your startup or to your company. Can you talk a little bit about what those patterns are, what they're looking for? What are the check marks that if you need to have at least these three things, otherwise they're not even going to talk to you?
Yeah, I think at a high level, it all boils down to the credibility that you can establish in the story, and the proof points are going to be different, I think, for different businesses. And so, you obviously want to be talking to them about a large market opportunity, and that you're entering into that market with a viable product that is going to solve what you say it's going to solve, and it's a big market. I think they also are going to look to see what other companies have gotten funded in this space. How far behind are you? Is the space big enough for multiple entrants? That's going to be an important pattern for them to look at. It's rare that you're going to show up, I think, with something that's unique. And by the way, if you show up with something that's unique and you're the only person that knows about it, there's a lot of people who are going to look at that and be like, well, that must not be
right,
a real thing, right?
Right.
There's no unique opportunities. There could be. Just be prepared that if you're in that situation, the risk averse, or the people who are looking at the world for additional evidence and support and are not finding it, they're going to need to be convinced a slightly different way.
Move to the Valley and get a Stanford PhD. It will cost you less money and less time than trying to convince non-Valley related. If you're not talking to Sequoia, right?
Right. And then I think also, how do they feel about you as the leader and the person in charge?
We're screwed, Anthony. Yeah, that's very much.
And what had, how systematically are you explaining the journey that you've been on? And you can really show, like, I did this and then this happened. I tried this and it didn't work and we ended up doing this, where they really can get a sense of, like, hey, this is a person who's got their hands on the levers and is really, like, scanning everything that's going on and making good decisions along the way. So we can rely on this person. If we back them, they're a backable person. So those are, like, the proof points that you would demonstrate as, like, the founder and leader of the business.
I wanted to hit one more point, and then we're going to go to the speed round. So briefly, and we've already touched on it, but I want to just reiterate the point before we go, which is they're investors. They're human beings, Sal. They're trying to get a return on their investment. We as founders sometimes think of them as aliens. Like, we don't understand how they think. We don't understand why they make investments, why they don't. It feels secretive. It feels strange. But your point is a great one. And Anthony, you made the same one, which is we need to continue to think of these. What is the outcome they're going for, and how can I help them get there? How do you think about that, or how do you coach founders, Sal, to be like, hey, look, I'm just trying to get a return on my investment here. You need to paint a picture that I can do that.
Yep, exactly.
Anthony, agree, disagree?
Yeah, that's an easy one. You have to as a founder, in general, across everything that you do, you have to understand why you're doing it.
Right.
Right. What's the motivation for an investor to invest? What's the motivation for a partner to want to partner with you? What's the motivation for an employee wanting to come work for you? What's the motivation for a customer wanting to open their wallet for you? Like that is the fundamental job of every leader, not just founder.
The other thing that struck me, Sal, is that people that I know that have done this job, like Anthony and I, we've done it a few times. We understand that it's a discipline, and it's just like being good at any other part of your business. Investor relations is a job, and it has to be your job as
It's a craft. Yeah,
Yeah.
it's a craft.
And it's not something you can outsource. It's just like early sales. You can't outsource early sales, at least in my opinion. You have to be a person that can go out and tell that story. And the craft, you can hone your craft in investor relations the same way you can hone your craft in any other part of your business. But it's hard. And you got to do it.
It's hard.
I have one more question for you, Sal. In my experience talking to specifically venture companies, but just large, companies that invest in bigger than seed rounds, past the seed stage. I haven't seen a lot of folks, and this just might be the people that I've talked to. So my data set of one, right? I haven't seen a lot of folks that have actually built anything. They're money people, not builders. And I think that's where the disconnect is. Is my perspective unique, or is that somewhat true?
Yeah, I mean, I think it's somewhat true. There's a few different ways I could answer that, especially if you get into like the private equity world, where I think they've got more operational talent, especially the bigger funds that can afford to have operating partners, more operational talent like on their teams. And so, but also the investors who have been around for a long time and have a lot of cycles doing investing and have seen a lot of businesses evolve and develop. Yeah, they're not in there running and building those businesses, but definitely make no mistake, they know what it's like to see businesses grow and evolve, and they've got a lot of information from all their other deals to draw from. It's not quite the same as having built a business, but
they've seen the patterns, right? They can recognize the patterns.
They have pattern recognition that they can leverage, and they also have great networks that can help make you more successful, right? But I would say if you're working, with a new fund or more junior people on the team, you may be dealing with less of those assets on the other side of the table that you could really leverage, and as a result of that. And I find it particularly when things kind of go sideways on you, that they are going to struggle a bit to
help you get out of a hole.
Help you get out of a hole, right? Especially
that's code word for you're going to get fired.
That's especially
the founder's typically going to get fired as a CEO at that point.
Yeah, especially in earlier stage deals where their time is best spent on, the successful deals. And then all of a sudden you fall out of that camp, you're in that.
Such a great point.
And then you are going to get less focus and attention because they're spreading their bets and they're looking for the couple of winners that are going to pay back huge.
Yeah. The fund makers.
And if once you fall out of that, you can, pivot and move around and maybe get back into that category of investments that they've got. But it's tough. And so you should be prepared if you do fall out of that top tier.
That's such a great point.
You're going to have more
really
work to do on your own.
Yeah. I want to restate that because that underscore. That's a really great point. Are you going to spend your time? Founder, now you're an investor. You have $100 million to invest. You invest in 10 companies. 3 are doing phenomenally well. 7 are struggling. Where are you going to spend your time?
Yeah.
And maybe a note to VCs, maybe you bring in a fixer. Maybe you bring in somebody that specializes in, and they're only allowed to touch the 7 that are struggling.
It is
it's
shocking,
a great
Anthony,
point. It's such a great point.
But it's shocking about how little founders know about VC's business models.
Yeah.
And when they're sitting across the table, they're making a bet on you, but they're also assuming that, what, South 80%, seven or 8 out of 10 of their investments is going to fail.
9
right.
out of
Or
10,
just not
right?
do well. Maybe not
Yeah, not
fail,
do well,
but just
yeah.
not do well. I mean, they don't want to lose money on those deals. Don't get me wrong. They're not just like walking away, but it's they want to invest in their strengths and spend time where they know they're going to crush it, because if they can get a deal that they think is going to do 5x their investment to do 20x, that's way better than a deal that they may get their money out that they could turn into a double, right?
Yeah. I mean, famously, Foundry in Colorado, Sal, they had, I think it was their second or third fund or whatever. They were early in Zynga. Zynga went zero to public in 18 months or something like that. And the rest of their companies at that point, they're like, I'm sure that they wanted them to be successful.
Yeah.
But
I mean,
like
who
once
wouldn't?
you've had a 0 to 18-month IPO, like the fund's pretty good.
Yeah.
We're okay. We're returning our capital to our LPs. All right,
Yeah.
let's go into the speed round, Sal. All right, Sal, is customer revenue always better than investor funding? Yes.
Yes.
I like it. Raise from angels or wait for professional VC?
Wait, sorry. What was the question again?
Should you raise from angels, or maybe like Anthony's saying, friends, family, fools, or should you wait to try to get actual proper VC money?
I would say angels, get the money as soon as you can.
Should you ever give up control of your board or control for more capital?
As a founder, I would say no.
No, but sometimes you're going to have to. So that's
That's a great question. That's a great question.
Is transparency about business challenges with investors beneficial or risky?
I think it's beneficial.
I do as well. And really good conversation, Sal. I appreciate you, man. Anthony, what did you learn from today's episode?
Oh, first of all, I want to have an entire episode on transparency. That was a great question.
Yeah, what are you
Chris.
telling? What are you not?
All right, so I fundamentals. This is a weird world, right? So you need, if you're going to go raise capital, you need to understand it from the investor's perspective. Sal said something, bootstrap when you have early product market fit, if you can, and raise capital when customer acquisition takes time or is not fully baked. And Chris, you added a third, which was it's just a capital intensive business. Validate the round with valuation and cash in with friendlies before you go to market. So try to make sure that you're not in that ridiculous zone that Sal mentioned.
Every one of my companies is $1 trillion company, Sal. My is like that.
And something we didn't talk about, if you decide to raise capital, calculate the cost of capital, and you can actually use AI to help you do that. Calculate what is this capital actually going to cost me? Sometimes debt is a better road than venture. Venture could be a lot more expensive, although a lot less cash flow burden on the business. So just be careful with that. Those are things that I had, Chris.
Go hang out with your one MBA nerd friend and ask him to calculate your cost of capital, because it's a fun exercise. All right, deep dive. It's almost required reading, I think, and I think too few founders read this book. It's called Venture Deals by Brad Feld. Brad Feld, obviously famous Colorado investor, but he wrote a terrific book that does explain the mechanics of venture deals, and he just walks through it step by step. Terrific book. There's a few other good ones. The Customer Funded Business by John Mullins talks more about bootstrapping. The Art of Startup Fundraising by Alejandro Cromatis, and Built to Sell by John Warrillo. And we're all just going to call you, Sal. How do we get in touch? Where can we find out more information about you? Where do you want us to go to just pepper you with all our VCs?
Sure. Yeah. So I run a CFO services business for emerging companies. We work with venture-backed companies, but also most of our clients are family and founder-owned businesses that have bootstrapped their way to tens of millions of revenue, and we provide full-stack CFO services to them that really gives them the top-notch capabilities in a permanent part-time package that is very affordable. And we also do a tremendous amount of work in business intelligence and analytics for some of our more mature clients, where they never knew that you could stand up a BI system in 30 days and have real-time metrics on your customer acquisition costs and your cancellation rates and stuff like that. So we do that as well, because we view operating data as just a foundational component of finance in general. So we're attached at the hip with that to help make these companies grow and develop as quickly as possible. And so you could find us at cfoproanalytics.com. I also have a blog on Substack. If you just Google my name, you'll find me on LinkedIn and on Substack. On Substack, I write articles for the general audience to sort of distill down important financial and analytical topics in a way that makes them more real for people. I just recently did a blog on what are the kitchen table dynamics in a family-owned business that is importing from China, and
That's a great one.
Very specific.
What are they going to face? Yeah, I mean the reason I
That's
did
awesome
that
though.
The reason I did that is, I'm watching CNBC, I'm watching some news channels, and you get really high level discussions about the impact of this, and automobiles are going to cost this much and that, but there are a lot of small businesses that do import from overseas and distribute in the US. And I give some statistics of that. And then I explain what are the microeconomics and what are they going to face in terms of cost cutting, raising prices, how does it change demand? So those are the types of things that I talk about to try to make it more real for people.
I think it's a great series of conversations and appreciate it. Anthony, what do we have coming up? Again, Sal, thank you so much for joining us.
Thank you, Sal.
It was great. I really enjoyed it.
We got a lot of comments from founders trying to raise money, thinking that commenting on our post on LinkedIn is actually going to get them to capital. So I apologize to everybody commenting on this stream on LinkedIn.
Also, you're clearly not listening.
For everybody else, visit us at howtofounder.com. Subscribe to us on LinkedIn, YouTube, Apple Podcasts, Spotify. And next, Chris, we're talking about on Monday, we're talking about managing imposter syndrome. So that's going to be a lot of fun. Everybody, thank you so much, Sal. Thank you. All right.
Great meeting you guys. Bye.
Bye.